Final strike. Japan has stopped exporting to China. Softbank and Alibaba go bankrupt immediately. China's steel industry is collapsing. Professor John Mearsheimer, an esteemed expert in international relations, recently presented an insightful analysis on the ramifications of ANA's decision to cease its shipping cooperation with China. His remarks emphasized the significant impact this strategic move has had on China's export-oriented economy, drawing from his expertise and real-life examples of how such disruptions alter global trade dynamics. Mearsheimer began by noting that ANA's extensive air cargo operations have long been a cornerstone for high-value goods leaving China, particularly in the realms of electronics, automotive components, and consumer goods. These products are central to China's manufacturing dominance, with global supply chains heavily reliant on efficient and timely delivery. ANA's decision to halt cooperation, however, disrupted this delicate balance, leaving Chinese exporters scrambling for alternatives at a higher cost and lower efficiency. The professor highlighted the domino effect of such an interruption. For example, Chinese companies like BYD, which depend on air freight for exporting electric vehicle components to Japan and beyond, have faced delays and escalating logistics costs. Similarly, Huawei, a significant player in consumer electronics, encountered increased challenges in delivering products to international markets. According to industry reports, this disruption has caused delays of up to 30% in meeting overseas demand for certain goods. Mearsheimer linked this development to broader geopolitical tensions, particularly between Japan and China, exacerbated by disputes over the Senkaku Islands and China's growing militarization in the East China Sea. ANA's decision, while economically impactful, can also be seen as a symbolic move reflecting Japan's alignment with policies that emphasize reducing reliance on China as a trading partner. The professor noted that this alignment dovetails with Japan's strategic pivot to diversify its trade partnerships, particularly in Southeast Asia and India. One striking observation in Mearsheimer's analysis was how this logistical disruption exposed vulnerabilities in China's just-in-time manufacturing model. Many Chinese exporters have relied on ANA's punctuality to ensure that goods arrive on time to meet international demand. Without this lifeline, production schedules have been thrown off balance, leading to inventory backlogs and reputational damage for companies striving to maintain reliability on the global stage. The professor elaborated on the financial toll this decision has taken on China's export economy. According to recent data, industries most reliant on air freight such as electronics and precision machinery have witnessed a decline in export volume by approximately 15% over the past quarter. The added burden of securing alternative logistics solutions has driven up costs for manufacturers, further eroding profit margins in already competitive global markets. Mearsheimer also addressed the strategic countermeasures by Japan, which, as he observed, are a calculated response to mitigate risks tied to China's dominance in certain sectors. Japan's focus on strengthening regional trade agreements and investing in alternative trade routes through India and ASEAN countries reflects a broader strategy to insulate itself from potential supply chain disruptions. In his concluding remarks, Mearsheimer warned that while ANA's decision might seem like a logistical matter, its implications are deeply intertwined with larger geopolitical shifts. He emphasized that this is a significant moment not just for China, but for the global trading system, as nations increasingly rethink their economic dependencies and realign their partnerships in light of emerging risks. In a detailed analysis by Professor John Mearsheimer, the recent decision by SoftBank to sell a significant portion of its shares in Alibaba was presented as a defining moment in the shifting economic and geopolitical landscape. Mearsheimer highlighted how this move not only signals a profound shift in corporate strategy but also delivers a substantial blow to China's economic stability, particularly its flagship technology sector. SoftBank's long-standing partnership with Alibaba has been a cornerstone of the Chinese tech giant's global expansion. From its initial investment, SoftBank reaped immense returns as Alibaba grew to dominate e-commerce and cloud services, both in China and internationally. However, Mearsheimer explained, the divestment reflects growing concerns over the volatility of the Chinese market. With increasing regulatory crackdowns by Beijing on domestic tech companies and a general decline in investor confidence, SoftBank's decision was a calculated response to mitigate risks. The repercussions for Alibaba were immediate and far-reaching. As one of its largest shareholders, SoftBank's sell-off triggered a sharp drop in Alibaba's stock price, eroding billions in market value. Mearsheimer emphasized that this loss in market capitalization was more than just a financial setback. It represented a symbolic loss of trust in the stability of Chinese tech giants. The sale further diminished Alibaba's standing among global investors, already wary of Beijing's tightening grip on the private sector. Professor Mearsheimer delved into the broader implications for China's tech industry. With Alibaba as a beacon of Chinese innovation and entrepreneurship, its struggles reflect the mounting challenges faced by the sector. Tightened regulations, including restrictions on overseas listings and data-sharing protocols, have created a hostile environment for growth. Mearsheimer argued that such policies, while framed as necessary for national security, have had the unintended consequence of driving away international investment, as evidenced by SoftBank's withdrawal. The decision also underscores SoftBank's shift in focus. Mearsheimer noted that the conglomerate is now channeling its resources into sectors such as artificial intelligence and biotechnology, often in markets outside of China. This pivot illustrates a broader trend of global companies seeking to reduce their exposure to risks associated with Chinese markets. For SoftBank, selling Alibaba shares was a step toward liquidity and diversification, but for China, it highlighted the fragility of its once unquestioned position as a hub for global tech investment. Mearsheimer's analysis didn't stop at the financial implications. He explored the geopolitical dimension of this move, noting that the souring relations between China and major global economies, including Japan, the United States, and the European Union, have further compounded the challenges for Chinese companies like Alibaba. The increasing alignment of these economies in countering China's global ambitions has created an environment where even the most successful Chinese enterprises face barriers to growth. Professor John Mearsheimer's analysis of the bankruptcy of China Baowu Steel Group and Chalco offers a striking portrayal of how economic sanctions imposed by Japan and the European Union are now driving China's industrial giants to the brink of collapse. His assessment frames these events within the broader context of growing international pressure on China, particularly within its core industries, such as steel and aluminum, which have long been pillars of the country's economic power. Mearsheimer emphasized that China Baowu Steel, the largest steel producer in China and one of the world's biggest, has faced significant financial strain due to the combination of sanctions that have targeted its products in major Western and Japanese markets. These sanctions, part of a coordinated effort by Japan and the EU, are designed to limit China's access to critical markets and raw materials. Baowu, once a symbol of China's industrial might, now finds itself grappling with dwindling exports, as the EU and Japan, both key players in the global steel market, have shifted their trade policies to favor other suppliers. The ripple effects of these sanctions have been swift and devastating, with Baowu's financial reports showing sharp declines in revenue and market share, alongside an increasing inability to meet production targets due to disruptions in supply chains and the cost of sourcing alternative raw materials. Similarly, Chalco, another Chinese industrial giant, has also been caught in the crossfire of these sanctions. The aluminum industry, where Chalco has been a dominant force, relies heavily on international trade, and the EU and Japan's targeted sanctions have dealt a crushing blow. These sanctions have not only limited Chalco's access to Western markets but have also restricted the company's ability to procure advanced technology and equipment crucial for maintaining its competitiveness. Mearsheimer pointed out that Chalco's reliance on these international markets for both sales and technological advancements made it highly vulnerable to sanctions. With major revenue streams severed, the company faced unsustainable financial pressure. As a result, Chalco was forced to declare bankruptcy, a symbolic blow to China's ambitions to dominate global markets in critical industries such as metals and minerals. The professor also noted that these bankruptcies signal a significant shift in China's economic trajectory. While these companies' failures are deeply rooted in direct financial losses, they also point to a broader structural issue within China's economy: its over-reliance on international trade and raw material imports. Mearsheimer argued that the imposition of sanctions by Japan and the EU, while framed as a response to political and security concerns, has inadvertently exposed China's vulnerability. The losses suffered by Baowu and Chalco are emblematic of how China's once seemingly invincible industrial base has been eroded by global economic and political forces. Moreover, the professor underscored the geopolitical dimension of these sanctions. The increasing alignment of Western countries, including Japan and the EU, in countering China's economic rise has led to strategic decisions aimed at reducing China's dominance in key sectors. These coordinated efforts to cripple China's steel and aluminum industries demonstrate the lengths to which Western powers are willing to go to disrupt China's global economic ambitions. Mearsheimer pointed out that this trend is likely to continue, with more Chinese companies facing similar pressures, particularly in industries where China has been attempting to expand its technological edge. In his analysis, Professor John Mearsheimer provides a stark picture of China's growing economic difficulties, emphasizing how a combination of domestic challenges and international pressures is cornering the country's economy. As Mearsheimer explains, the series of events leading to China's economic turmoil is not merely a result of short-term missteps, but rather the culmination of years of overdependence on exports and a failure to adapt to an increasingly hostile global environment. China's economic troubles are evident in several sectors, particularly in manufacturing and exports, which have long been the backbone of its growth. Mearsheimer notes that the imposition of trade barriers, such as the sanctions from the EU and Japan, which were targeted at key industries like steel and aluminum, has seriously undermined China's manufacturing capacity. These sanctions, which have severely limited China's access to critical export markets, have led to a significant contraction in demand for Chinese goods. This shift has had an immediate impact on industries that rely heavily on these markets, such as Baowu Steel Group and Chalco, two companies at the forefront of China's industrial dominance, which have now gone bankrupt as a direct result of these global shifts. Mearsheimer elaborates on the financial strain that China is under, particularly the pressure faced by major industrial players that have been affected by these sanctions. The professor highlights that the bankruptcies of Baowu Steel and Chalco, while dramatic, are merely symptoms of a deeper issue: China's unsustainable model of economic expansion through exports. With global demand for Chinese products dwindling, particularly in Europe and Japan, the country's reliance on export-driven growth has been exposed as fragile and prone to disruption. The economic slowdown has been compounded by a growing lack of investor confidence, as foreign companies increasingly retreat from China due to regulatory uncertainties and geopolitical tensions. Furthermore, Mearsheimer addresses the ripple effect these developments have had on China's broader economy. The professor underscores that China's domestic economic policies, such as its overinvestment in infrastructure and its push for high-tech industries like semiconductors and artificial intelligence, have not yielded the returns expected. The failure to secure stable domestic markets in these industries has left China vulnerable to external shocks. The collapse of these industries, which had been expected to drive China's future economic growth, reflects the country's vulnerability in an increasingly competitive and politically fragmented global market. Mearsheimer also brings attention to the political consequences of these economic challenges. He points out that China's increasing isolation, not just economically but diplomatically, has made it difficult for the country to recover. As Western countries strengthen alliances to counter China's influence, China's leadership faces mounting pressure from within to find solutions. However, the professor suggests that the authoritarian nature of China's political system may hinder necessary economic reforms. The focus on controlling key sectors has led to inefficiencies and stagnation, as the government struggles to balance its desire for global influence with the need for domestic stability.